Introduction to Global Real Estate. Global real estate encompasses all land and buildings worldwide, representing a significant portion of global wealth and economic activity. It is a diverse asset class, including residential, commercial, industrial, and specialized properties, each with unique characteristics and market drivers. Understanding its complexities requires an appreciation for interconnected economies, diverse cultures, and evolving regulatory landscapes. This course will delve into the fundamental concepts that underpin these vast markets, providing a framework for analysis. We will explore how local dynamics often reflect broader international trends, making a global perspective essential for informed decision-making. The sheer scale and variety of global real estate make it a fascinating and challenging field of study. The global real estate market is influenced by a myriad of factors, ranging from interest rates and inflation to geopolitical stability and technological advancements. These influences create a constantly shifting landscape, presenting both opportunities and risks for investors and developers. Recognizing these drivers is crucial for predicting market movements and formulating effective strategies. Furthermore, the long-term nature of real estate investments means that foresight and adaptability are paramount. This introductory section lays the groundwork for a deeper exploration of these intricate relationships, emphasizing the importance of a holistic view. We will begin by identifying the core components that define this expansive sector. Key drivers of real estate markets. Real estate markets are profoundly shaped by a combination of economic, social, and political factors that dictate supply and demand dynamics. Economic growth, for instance, directly influences job creation and household income, subsequently boosting demand for both residential and commercial properties. Interest rates play a critical role, affecting borrowing costs for mortgages and development loans, thereby impacting affordability and investment viability. Inflation can erode purchasing power, but also drive up property values as a hedge against currency devaluation. Understanding these fundamental economic forces is paramount for any real estate analysis. Furthermore, global trade agreements and currency fluctuations can have significant cross-border implications. These drivers are rarely isolated, often interacting in complex ways to produce market outcomes. Beyond economics, demographic shifts are powerful long-term drivers, including population growth, aging populations, and migration patterns. Social trends, such as changing household structures or preferences for urban versus suburban living, also significantly influence property demand and development. Political stability and government policies, including zoning laws, taxation, and infrastructure spending, directly impact the feasibility and profitability of real estate projects. Environmental regulations, particularly those related to sustainability and climate change, are increasingly shaping development practices and property values. Geopolitical events, like trade wars or international conflicts, can introduce significant uncertainty and risk, affecting investor confidence and capital flows. These diverse factors create a multifaceted environment for real estate. Economic indicators and real estate gross domestic product (GDP) growth is a primary indicator, as a rising GDP generally correlates with increased economic activity, job creation, and higher demand for all types of real estate. Employment rates are also crucial. Low unemployment typically means more disposable income and greater housing demand, while high unemployment can lead to foreclosures and reduced commercial activity. Inflation, measured by indices like the Consumer Price Index (CPI), affects construction costs, property values, and rental income, influencing investment returns. Interest rates, set by central banks, directly impact mortgage affordability and the cost of capital for developers, significantly influencing market liquidity and investment decisions. Understanding these macroeconomic indicators provides a foundational understanding of market health. Consumer confidence surveys offer insights into public sentiment regarding economic conditions, which can influence buying and selling decisions in the housing market. Retail sales data provides an indication of consumer spending, directly impacting the performance of commercial retail properties. Construction spending and housing starts are forward-looking indicators of future supply, helping to gauge potential market saturation or shortages. Rental vacancy rates for both residential and commercial properties are critical supply-demand metrics, indicating market tightness or oversupply. Analyzing these indicators in conjunction provides a comprehensive picture of current market conditions and potential future trends, allowing investors to make more informed decisions about timing and location. Demographic shifts in housing. Population growth is a fundamental driver of housing demand, as more people require more places to live, work, and shop. However, the composition of this growth is equally important. An aging population, for example, may increase demand for assisted living facilities and smaller, accessible homes, while a younger population might seek starter homes or rental apartments. Birth rates and mortality rates directly influence the overall population trajectory, impacting long-term housing needs. Understanding these broad demographic trends is essential for strategic planning in real estate development and investment. Different regions experience vastly different demographic patterns, leading to localized market variations. These shifts are often slow but exert profound, lasting effects on property markets. Migration patterns, both internal and international, significantly redistribute housing demand, leading to boom and bust cycles in specific cities or regions. Urbanization continues globally, drawing people to cities for economic opportunities, which fuels demand for high-density housing and commercial spaces in metropolitan areas. Conversely, suburbanization or even exurbanization can occur, driven by factors like affordability or lifestyle preferences, creating demand in peripheral areas. Household formation rates, influenced by cultural norms and economic conditions, determine the number of independent housing units required. These intricate demographic shifts require careful monitoring to anticipate future housing needs and investment opportunities. Analyzing these trends helps identify areas of potential growth or decline. Technological impact on real estate. Technology is rapidly transforming every facet of the real estate industry, from how properties are marketed and sold to how they are designed, built, and managed. Online platforms and virtual reality (VR) tours have revolutionized property viewing, making it accessible to a global audience and streamlining the sales process. Artificial intelligence, AI, and machine learning are being used for predictive analytics, helping investors identify market trends, optimize pricing, and assess risk with greater accuracy. Blockchain technology offers the potential to enhance transparency and security in property transactions, simplifying complex legal processes and reducing fraud. These innovations are making real estate more efficient and accessible than ever before. The pace of technological adoption continues to accelerate, demanding constant adaptation from industry professionals. Smart building technologies are enhancing efficiency and tenant experience by integrating sensors, automation, and data analytics to optimize energy consumption, security, and maintenance. The Internet of Things, IoT, connects various building systems, allowing for proactive management and personalized environments. PropTech, a broad term for real estate technology, encompasses these advancements and more, driving innovation across the sector. Data analytics provides deeper insights into tenant behavior, property performance, and market demand, enabling more informed decision-making. These technological shifts are not just incremental improvements, they are fundamentally reshaping the value proposition of real estate assets and creating new business models. Embracing these tools is crucial for staying competitive in the modern market. Urbanization and megacities. Urbanization is a relentless global trend, with an increasing proportion of the world's population migrating to cities in search of economic opportunities and improved quality of life. This phenomenon leads to the rapid growth of existing cities and the emergence of new urban centers, profoundly impacting real estate demand and development patterns. Megacities, defined as urban areas with populations exceeding 10 million, are at the forefront of this trend, acting as global economic hubs and magnets for talent and capital. Their sheer scale presents unique challenges and opportunities for real estate, driving demand for high-density residential, commercial, and infrastructure projects. The concentration of people and businesses in these areas creates intense competition for space. Understanding the dynamics of urbanization is crucial for anticipating future real estate needs. The rapid expansion of megacities often leads to significant infrastructure development, including transportation networks, utilities, and public services, which in turn drives further real estate investment. However, it also creates challenges such as housing affordability crises, increased traffic congestion, and environmental strain. Sustainable urban planning and smart city initiatives are becoming critical to manage this growth effectively, focusing on green buildings, efficient public transport, and mixed-use developments. These efforts aim to create livable, resilient, and economically vibrant urban environments. Real estate professionals must navigate these complexities, identifying opportunities in areas undergoing regeneration or strategic expansion, while also addressing the social and environmental impacts of rapid development. The future of real estate is inextricably linked to the future of our cities. Sustainability and green buildings. Sustainability has become a paramount consideration in global real estate, driven by increasing environmental awareness, regulatory pressures, and investor demand for responsible assets. Green buildings are designed, constructed, and operated to minimize their environmental impact, often incorporating features like energy-efficient systems, renewable energy sources, water conservation technologies, and sustainable materials. These buildings not only reduce carbon footprints, but also offer long-term operational cost savings through lower utility bills. Certifications like LEED, Leadership in Energy and Environmental Design, and BREEAM, Building Research Establishment Environmental Assessment Method, provide benchmarks for sustainable construction and performance. The market for green buildings is expanding rapidly as both tenants and investors prioritize environmental, social, and economic impact and governance (ESG) factors. This shift reflects a broader commitment to ecological responsibility within the industry. The benefits of green buildings extend beyond environmental protection to include improved occupant health and productivity, enhanced marketability, and higher property values. Investors are increasingly recognizing that sustainable properties are more resilient to future climate risks and regulatory changes, making them more attractive long-term assets. Retrofitting existing buildings with green technologies also presents a significant opportunity to reduce energy consumption and extend their life cycle. Governments worldwide are implementing policies and incentives to encourage sustainable development, further accelerating this trend. As climate change concerns intensify, the integration of sustainability principles into real estate development and management will only become more critical, shaping the future landscape of the built environment. This focus ensures properties are not only economically viable, but also environmentally sound. Global capital flows in real estate. Global capital flows refer to the movement of money across international borders for investment purposes, and real estate is a significant recipient of this capital. Institutional investors, such as pension funds, sovereign wealth funds, and insurance companies, increasingly allocate portions of their portfolios to international real estate for diversification and stable returns. Cross-border investment can take various forms, including direct property acquisitions, investments in real estate funds, or purchases of publicly traded real estate investment trusts, REITs. These flows are driven by factors like interest rate differentials, currency exchange rates, economic growth prospects in different regions, and perceived political stability. Understanding the direction and magnitude of these flows is crucial for identifying hot markets and potential risks. The search for yield in a low-interest rate environment has particularly fueled this trend. The impact of global capital flows on local real estate markets can be profound, often leading to increased property values, especially in prime locations within gateway cities. While this can stimulate development and economic growth, it can also contribute to affordability challenges for local residents. Regulatory environments, including foreign ownership restrictions and taxation policies, play a significant role in attracting or deterring international investment. Geopolitical events and global economic crises can quickly alter capital flow patterns, leading to sudden shifts in market dynamics. Monitoring these movements helps investors anticipate market changes and adjust their strategies accordingly. The interconnectedness of global financial markets means that real estate is no longer a purely local asset class, but rather a component of a larger international investment landscape. Investment strategies: direct versus indirect. Real estate investment can be broadly categorized into direct and indirect strategies, each offering distinct advantages and disadvantages. Direct investment involves purchasing and owning physical properties, such as residential homes, office buildings, or industrial warehouses. This approach provides investors with full control over the asset, including management decisions, leasing, and property improvements. It also offers the potential for direct appreciation and rental income. However, direct investment typically requires substantial capital, involves significant management responsibilities, and can be illiquid, making it challenging to sell quickly. Due diligence is extensive, and local market knowledge is paramount for success. This hands-on approach appeals to those seeking tangible assets and operational control. Indirect real estate investment, conversely, involves investing in entities that own or manage properties, rather than owning the properties directly. Common indirect vehicles include real estate investment trusts, REITs, which are companies that own, operate, or finance income-producing real estate and are traded on stock exchanges. Other options include real estate funds, private equity funds, and crowdfunding platforms. Indirect investment offers greater liquidity, diversification across multiple properties, and professional management, often with lower capital requirements. However, investors have less control over individual assets and are subject to stock market volatility. The choice between direct and indirect strategies depends on an investor's capital, risk tolerance, desired level of control, and liquidity needs. Both strategies play crucial roles in global real estate portfolios. Emerging markets opportunities. Emerging markets characterized by rapid economic growth, increasing urbanization, and expanding middle classes present compelling real estate investment opportunities. These markets often offer higher potential returns compared to more mature developed economies, driven by strong demand for new infrastructure, housing, and commercial spaces. Countries in Southeast Asia, parts of Latin America, and Africa are experiencing significant demographic shifts and economic development, creating fertile ground for real estate expansion. Investors can capitalize on the early stages of market development, benefiting from capital appreciation as these economies mature. However, these opportunities come with inherent risks that require careful consideration. The growth trajectory can be steep, attracting significant international capital looking for higher yields. Despite the high growth potential, investing in emerging markets carries elevated risks, including political instability, currency volatility, less transparent legal and regulatory frameworks, and potential infrastructure deficiencies. Due diligence is particularly critical, requiring thorough research into local market conditions, property rights, and potential barriers to entry or exit. Understanding the specific cultural nuances and local business practices is also essential for successful investment. While the rewards can be substantial, a comprehensive risk assessment and a long-term investment horizon are necessary. Diversification across different emerging markets and property types can help mitigate some of these risks, allowing investors to tap into the growth stories while managing exposure. Navigating these markets requires expertise and a nuanced approach. Developed market stability. Developed real estate markets, found in countries with mature economies like the United States, Western Europe, Japan, and Australia, are characterized by stability, transparency, and established legal frameworks. These markets typically offer lower but more predictable returns compared to emerging markets, appealing to investors seeking long-term capital preservation and steady income streams. They feature well-developed infrastructure, sophisticated financial systems, and a high degree of market liquidity, making it easier to buy and sell properties. The regulatory environment is generally robust and transparent, reducing investment uncertainty. While growth rates may be modest, the reliability and lower risk profile of developed markets make them a cornerstone of many global real estate portfolios. Investors often prioritize these markets for their defensive qualities. Investment in developed markets often focuses on core assets in prime locations, such as trophy office buildings, high-end residential properties, and established retail centers. These assets tend to hold their value well during economic downturns and provide consistent rental income. The mature nature of these markets means that innovation often centers on sustainability, technology integration, PropTech, and adaptive reuse of existing structures, rather than entirely new urban development. While competition for prime assets can be intense, the depth of the market allows for diverse investment strategies. Understanding the nuances of these stable markets is crucial for balancing a global real estate portfolio, providing a counterpoint to the higher risk, higher reward opportunities in emerging economies. They offer a reliable foundation for long-term wealth accumulation. Regulatory frameworks and policies. Regulatory frameworks and government policies exert a profound influence on real estate markets globally, shaping everything from land use and development to property ownership and taxation. Zoning laws dictate what can be built where, impacting property values and development potential. Building codes ensure safety and quality standards, affecting construction costs and timelines. Environmental regulations, increasingly stringent worldwide, influence sustainable development practices and the use of green technologies. Understanding these local and national regulations is paramount for developers and investors, as non-compliance can lead to significant delays, fines, or even project cancellations. The complexity of these frameworks often varies significantly between countries, requiring specialized legal expertise. Navigating these rules successfully is a critical component of real estate success. Government policies related to taxation, such as property taxes, capital gains taxes, and transfer taxes, directly impact the profitability of real estate investments. Foreign ownership restrictions, which vary widely by country, can limit international investment or dictate specific conditions for non-resident buyers. Infrastructure spending policies, including investments in transportation, utilities, and public amenities, can significantly enhance property values in targeted areas. Housing policies, such as rent controls or affordable housing mandates, aim to address social needs, but can also affect market dynamics and investor returns. Geopolitical stability and the rule of law are foundational. Transparent legal systems and predictable policy environments attract more capital, while uncertainty deters it. These policies are not static, requiring continuous monitoring and adaptation from real estate professionals. Geopolitical influences on property. Geopolitical events, such as trade wars, international conflicts, political instability, and changes in global alliances, can have profound and often unpredictable impacts on real estate markets worldwide. These events can disrupt supply chains, alter capital flows, and erode investor confidence, leading to shifts in property values and investment decisions. For example, increased trade tensions between major economies might deter cross-border investment in certain regions, while political unrest in a country can cause capital flight and a decline in property demand. Understanding the geopolitical landscape is crucial for assessing risk and identifying potential safe havens or vulnerable markets. The interconnectedness of the global economy means that a localized event can have ripple effects across continents, impacting real estate far from the initial point of conflict. This requires a nuanced and forward-looking analytical approach. Changes in government leadership or significant policy shifts can also introduce uncertainty, affecting investor sentiment and the attractiveness of a country's real estate market. For instance, new immigration policies can impact population growth and housing demand, while changes in foreign investment regulations can alter the ease of capital entry and exit. Currency fluctuations, often driven by geopolitical factors, can significantly affect the returns for international investors when converting profits back to their home currency. Furthermore, the perception of a country's stability and rule of law is a major determinant for long-term real estate investment. Real estate professionals must continuously monitor global political developments and their potential implications, integrating geopolitical risk assessment into their investment strategies. This proactive approach helps mitigate potential losses and capitalize on emerging opportunities. Real estate market cycles. Real estate markets typically operate in cycles, characterized by distinct phases of recovery, expansion, hypersupply, and recession. Understanding these cycles is crucial for making informed investment and development decisions, as timing can significantly impact returns. The recovery phase often begins after a recession, marked by declining vacancies, stabilizing rents, and cautious new construction. This leads into the expansion phase, where strong demand drives rising rents, increasing property values, and robust development activity. This period is typically characterized by optimism and significant investment. Recognizing the signs of each phase allows investors to position themselves strategically, anticipating future market movements. These cycles are influenced by a combination of economic, demographic, and financial factors. The hypersupply phase occurs when new construction outpaces demand, leading to rising vacancy rates and slowing rent growth. This oversupply eventually triggers a recessionary phase, characterized by falling rents, declining property values, and a halt in new development. The length and intensity of these cycles can vary significantly by market and property type, influenced by local economic conditions, capital availability, and regulatory changes. While cycles are inherent to real estate, their predictability is limited, requiring continuous monitoring and adaptive strategies. Investors aim to buy during recovery or early expansion and sell during the later stages of expansion or hypersupply, though precise timing is notoriously difficult. A deep understanding of these cyclical patterns helps mitigate risk and maximize potential returns over the long term. Residential real estate trends. Residential real estate, encompassing single-family homes, apartments, condominiums, and townhouses, is profoundly influenced by demographic shifts, affordability, and lifestyle preferences. Globally, urbanization continues to drive demand for high-density living in cities, leading to a rise in apartment and condo developments. Conversely, the desire for more space and a better quality of life can fuel suburban and exurban growth, particularly in regions where remote work has become prevalent. Affordability remains a critical concern in many major cities, pushing residents to seek housing in more accessible areas or to opt for rental properties over home ownership. Interest rates and mortgage availability are key determinants of buying power, directly impacting market activity. The interplay of these factors creates diverse residential market conditions across the globe. Technological advancements are also reshaping residential real estate, with smart home features becoming increasingly desirable, enhancing convenience, security, and energy efficiency. The rise of short-term rental platforms has introduced new dynamics, impacting traditional rental markets and sometimes leading to regulatory challenges. Sustainability is another growing trend, with demand for eco-friendly homes and communities increasing, driven by environmental awareness and long-term cost savings. Furthermore, changing household structures, such as smaller family sizes and an aging population, are influencing the types of homes being built and sought after. Understanding these evolving trends is essential for developers, investors, and policymakers to meet the diverse and changing housing needs of global populations. The residential sector is constantly adapting to societal changes. Commercial real estate dynamics. Commercial real estate, CRE, encompasses properties used for business activities, including office buildings, retail spaces, and industrial facilities. The office sector has undergone significant transformation due to remote work trends, leading to increased demand for flexible workspaces, co-working environments, and smaller, more collaborative office footprints. Companies are re-evaluating their space needs, prioritizing amenities and technology that support hybrid work models. Retail real estate continues to evolve, heavily impacted by e-commerce, necessitating a shift towards experiential retail, mixed-use developments, and last-mile logistics hubs. Understanding these shifts is crucial for investors and developers to adapt their strategies. The demand for well-located, high-quality assets remains strong, but the definition of quality is changing. The industrial and logistics sector, driven by the explosion of e-commerce, has experienced unprecedented growth, with strong demand for warehouses, distribution centers, and fulfillment centers. This demand is fueled by the need for efficient supply chains and rapid delivery services. Hospitality real estate, including hotels and resorts, is highly sensitive to travel patterns, tourism, and economic conditions. Experiencing significant fluctuations, but also showing resilience in leisure travel. Specialized commercial properties, such as data centers and healthcare facilities, are also gaining prominence driven by digital transformation and an aging global population. Each CRE segment has unique drivers and risks, requiring specialized knowledge for successful investment and management. Analyzing these dynamics helps identify areas of growth and potential decline. Industrial and logistics real estate. The industrial and logistics real estate sector has emerged as a powerhouse, driven primarily by the exponential growth of e-commerce and the increasing complexity of global supply chains. This sector includes a wide range of properties such as large-scale distribution centers, fulfillment centers, light manufacturing facilities, and urban last-mile delivery hubs. The demand for these properties is fueled by consumers' expectations for faster delivery times and businesses' need for efficient inventory management. Strategic locations near major transportation arteries, ports, and population centers are highly sought after, commanding premium rents. Automation and robotics are also transforming these facilities, requiring specialized designs and infrastructure. This sector is characterized by strong rental growth and low vacancy rates in many global markets, making it a favored asset class for investors. Technological advancements, particularly in automation and data analytics, are continuously reshaping industrial and logistics properties. Modern warehouses are increasingly equipped with advanced sorting systems, robotic picking technology, and sophisticated inventory management software to optimize operations. The rise of dark stores and micro-fulfillment centers in urban areas addresses the last-mile delivery challenge, bringing goods closer to consumers. Sustainability is also becoming a key consideration, with demand for green warehouses that incorporate renewable energy, efficient lighting, and water conservation measures. Investors are increasingly focused on properties that can adapt to future technological changes and supply chain demands. The resilience and growth potential of this sector make it a critical component of global real estate portfolios, reflecting fundamental shifts in how goods are produced, stored, and delivered worldwide. Retail real estate evolution. Retail real estate is undergoing a profound transformation, largely driven by the relentless growth of e-commerce and changing consumer behaviors. Traditional enclosed shopping malls are facing significant challenges, leading to closures or extensive redevelopments. The focus has shifted towards creating experiential retail environments that offer more than just shopping, incorporating entertainment, dining, and leisure activities to attract visitors. Mixed-use developments, combining retail with residential, office, and hospitality components, are becoming increasingly popular, creating vibrant urban hubs. Retailers are also leveraging technology to enhance the in-store experience, integrating digital tools and personalized services. Understanding these shifts is crucial for investors and developers to adapt their retail portfolios and create resilient assets. The physical store is not dead, but its purpose has evolved significantly. The rise of click-and-collect services and omni-channel retail strategies has blurred the lines between online and offline shopping, requiring retail properties to integrate logistics and fulfillment capabilities. Pop-up stores and flexible leasing models are gaining traction, allowing brands to test new markets or concepts without long-term commitments. High street retail in prime urban locations remains resilient, often benefiting from strong foot traffic and brand visibility, but even these areas are adapting to changing consumer demands. Sustainability is also influencing retail design, with demand for eco-friendly materials and energy-efficient operations. Successful retail real estate today is about creating dynamic, adaptable spaces that cater to evolving consumer preferences and provide compelling reasons for people to visit physical locations. This continuous evolution demands innovative approaches from all stakeholders. Hospitality and leisure properties. Hospitality and leisure real estate, encompassing hotels, resorts, service departments, and entertainment venues, is highly sensitive to global travel patterns, tourism trends, and economic conditions. The sector experienced significant disruption during the pandemic, but has shown remarkable resilience, particularly in leisure travel. Business travel and conventions are gradually recovering, albeit with new demands for flexible meeting spaces and enhanced health protocols. Investors are increasingly focused on properties that offer unique experiences, strong branding, and adaptability to changing consumer preferences. The rise of leisure travel, combining business and leisure, is also influencing hotel design and service offerings. Understanding the drivers of tourism and consumer spending is paramount for success in this segment. The sector's performance is closely tied to global economic health and consumer confidence. Technological integration is transforming the guest experience, with smart room features, mobile check-in, and personalized services becoming standard expectations. Sustainability is also a growing concern, with demand for eco-friendly hotels and resorts that minimize their environmental footprint. The growth of alternative accommodations, such as boutique hotels and glamping sites, caters to diverse traveler segments seeking unique stays. Emerging markets with growing middle classes and increasing tourism infrastructure present significant opportunities for new hotel development. However, the sector remains vulnerable to external shocks, such as economic downturns, health crises, and geopolitical events, requiring robust risk management strategies. Successful investment in hospitality real estate demands a deep understanding of market segmentation, operational efficiency, and the ability to adapt to rapid changes in consumer behavior and global events. Data centers and specialized assets. Data centers have emerged as a critical and rapidly growing specialized real estate asset class, driven by the explosion of digital data, cloud computing, artificial intelligence, and the Internet of Things. These facilities house vast networks of servers and related infrastructure, requiring massive power supplies, advanced cooling systems, and robust security measures. Demand for data centers is global and insatiable, as businesses and individuals increasingly rely on digital services. Investors are attracted to their long-term lease structures, high barriers to entry, and resilience to economic downturns. Strategic locations with access to reliable power, fiber optic networks, and low natural disaster risk are highly valued. Understanding the technical requirements and operational complexities of data centers is crucial for successful investment in this niche. Beyond data centers, other specialized real estate assets are gaining prominence, including life science facilities, cold storage warehouses, and purpose-built student accommodation. Life science properties, such as research laboratories and biotech manufacturing facilities, are driven by innovation in healthcare and pharmaceuticals, requiring highly specialized infrastructure. Cold storage warehouses are essential for the global food supply chain and pharmaceutical distribution, experiencing increased demand due to e-commerce and changing consumer habits. Purpose-built student accommodation caters to the growing international student population, offering modern, amenity-rich living spaces. Each of these specialized assets has unique demand drivers, operational complexities, and investment profiles, requiring deep sector-specific expertise. Their growth reflects fundamental shifts in technology, demographics, and global consumption patterns, offering diversification opportunities for real estate portfolios. Real estate technology, PropTech, or property technology, refers to the innovative technologies and digital solutions that are transforming the real estate industry across its entire life cycle. This includes everything from property search and marketing to construction, management, and investment. Key areas of PropTech include artificial intelligence, AI, for predictive analytics, virtual and augmented reality, VR, AR, for property tours and design visualization, and blockchain for secure and transparent transactions. These technologies are streamlining processes, improving efficiency, enhancing decision-making, and creating new business models. The rapid adoption of PropTech is driven by the industry's need for greater transparency, speed, and data-driven insights. It represents a significant shift from traditional, often manual, processes to a more digital and interconnected ecosystem. Further advancements in PropTech include smart building technologies that optimize energy consumption, security, and occupant comfort through IoT sensors and automation. Data analytics platforms provide deeper insights into market trends, tenant behavior, and property performance, enabling more informed investment and management strategies. Construction technology, ConTech, is improving building efficiency and safety through modular construction, drones, and advanced project management software. Fintech solutions are also integrating with real estate, offering innovative financing options and investment platforms. The continuous evolution of PropTech is creating a more efficient, transparent, and accessible real estate market globally. Embracing these innovations is no longer optional, but essential for staying competitive and unlocking new value in the modern real estate landscape. It is fundamentally reshaping how real estate is conceived, developed, and utilized. Risk management in global real estate. Investing in global real estate inherently involves various risks that must be carefully identified, assessed, and mitigated to protect investments and ensure sustainable returns. Market risk, stemming from economic downturns, oversupply, or shifts in demand, can lead to declining property values and rental income. Financial risk includes interest rate fluctuations, currency volatility for cross-border investments, and access to financing. Operational risks involve property management issues, tenant defaults, and unforeseen maintenance costs. Understanding the specific risk profile of each market and property type is the first step in developing effective risk management strategies. A comprehensive due diligence process is essential to uncover potential pitfalls before commitment. These risks are often interconnected, requiring a holistic approach to assessment. Beyond these common risks, global real estate faces unique challenges such as geopolitical risk, regulatory changes, and environmental risks. Geopolitical instability, trade wars, or international conflicts can disrupt markets and capital flows. Changes in local zoning laws, taxation policies, or foreign ownership restrictions can significantly impact investment viability. Environmental risks, including climate change impacts like rising sea levels, extreme weather events, and increased demand for sustainable properties, require forward-looking assessments and adaptation strategies. Implementing robust risk management frameworks, including diversification across geographies and asset classes, hedging currency exposures, and securing appropriate insurance, is crucial. Continuous monitoring of global and local factors allows investors to proactively adjust strategies and minimize potential losses, ensuring resilience in a dynamic market. Effective risk management is not just about avoiding losses, but also about identifying opportunities in challenging environments. Valuation methodologies. Accurate property valuation is fundamental to real estate investment, development, and financing decisions. Several methodologies are employed globally, each suited to different property types and market conditions. The sales comparison approach, SCA, also known as the market approach, estimates a property's value by comparing it to similar properties that have recently sold in the same market. Adjustments are made for differences in features, location, and condition. This method is widely used for residential properties and relies heavily on the availability of comparable sales data. Its effectiveness depends on a robust and transparent market with sufficient transaction activity. Understanding its strengths and limitations is crucial for reliable appraisals. This approach provides a market-driven perspective on value. The income capitalization approach, ICA, is primarily used for income-producing properties, such as commercial buildings and rental apartments. It estimates value based on the property's expected future income stream, converting net operating income, NOI, into a present value using a capitalization rate, cap rate, or a discount rate. The cap rate reflects the market's required rate of return for similar properties. The cost approach estimates value by calculating the cost to replace or reproduce the property new, minus depreciation, plus the value of the land. This method is often used for new construction or specialized properties where comparable sales or income data are scarce. Each methodology provides a different lens through which to view a property's worth, and often appraisers will use a combination of approaches to arrive at a final valuation, providing a more comprehensive and robust assessment. The choice's method depends on the specific asset and available data. Forecasting real estate trends. Forecasting real estate trends involves analyzing a multitude of data points and indicators to anticipate future market movements, demand shifts, and investment opportunities. This process relies on both quantitative and qualitative analysis, drawing insights from economic forecasts, demographic projections, technological advancements, and geopolitical developments. Key quantitative inputs include GDP growth rates, employment figures, interest rate predictions, and construction pipeline data. Understanding the interplay of these factors allows analysts to build models that project future property values, rental rates, and vacancy levels. However, forecasting is not an exact science. It involves making educated assumptions based on available information and expert judgment. The goal is to reduce uncertainty and provide a probabilistic view of future market conditions. Effective forecasting requires continuous data collection and model refinement. Qualitative factors, such as changes in consumer preferences, evolving lifestyle trends, and the impact of new government policies, also play a significant role in shaping future real estate landscapes. Expert interviews, market sentiment surveys, and scenario planning are valuable tools for incorporating these less quantifiable elements into forecasts. The rise of big data and advanced analytics is enhancing forecasting capabilities, allowing for more granular and real-time insights. However, unforeseen black swan events like global pandemics or major financial crises can rapidly alter market trajectories, highlighting the inherent limitations of any forecast. Therefore, a flexible and adaptive approach, regularly updating forecasts based on new information, is essential for navigating the dynamic global real estate market. Successful forecasting balances robust data analysis with an understanding of market complexities. Impact of climate change. Climate change poses significant and growing risks to global real estate, impacting property values, insurance costs, and development viability. Rising sea levels and increased frequency of extreme weather events, such as floods, hurricanes, and wildfires, directly threaten coastal properties and vulnerable regions, leading to physical damage and potential loss of assets. These risks are driving up property insurance premiums, and in some cases, making certain areas uninsurable or unmortgageable. Investors and developers must integrate climate risk assessments into their due diligence, considering the long-term resilience of properties and locations. The physical impacts of climate change are already being felt and are projected to intensify, necessitating proactive adaptation strategies across the industry. This is no longer a distant threat, but a present reality for many real estate assets. Beyond physical risks, climate change is also driving regulatory changes and shifts in market demand. Governments worldwide are implementing stricter building codes, carbon emission targets, and sustainability mandates, which influence construction practices and operational costs. There is a growing demand for green buildings and climate-resilient infrastructure. As tenants and investors prioritize properties with lower environmental footprints and greater protection against climate impacts, the transition to a low-carbon economy will also create opportunities for renewable energy projects and properties that support green industries. Real estate professionals must understand both the risks and opportunities presented by climate change, adapting their investment strategies to build more resilient and sustainable portfolios. This includes investing in mitigation measures, such as flood defenses and energy-efficient retrofits, and considering the long-term viability of assets in a changing climate. The industry has a critical role to play in addressing this global challenge. Future outlook for global real estate. The future of global real estate will be shaped by a confluence of accelerating trends, including continued technological innovation, evolving demographic patterns, and the imperative of sustainability. PropTech will further integrate into every aspect of the industry, driving efficiency, transparency, and new investment models. Artificial intelligence and big data analytics will provide increasingly sophisticated insights, enabling more precise valuations and predictive forecasting. Virtual and augmented reality will transform property marketing and design, offering immersive experiences. Understanding and embracing these technological shifts will be crucial for all stakeholders, from developers to investors and property managers. The industry is poised for continuous disruption and transformation, demanding agility and a forward-thinking mindset. The digital revolution in real estate is far from over, promising even more profound changes. Demographic shifts such as global population growth, urbanization, and the aging of populations will continue to dictate demand for various property types, requiring adaptable and diverse housing and commercial solutions. The focus on sustainability and climate resilience will intensify, driving investment in green buildings, renewable energy, and infrastructure that can withstand environmental challenges. Geopolitical stability and global economic health will remain critical factors influencing capital flows and market confidence. The real estate industry will need to navigate these complex interdependencies, balancing economic growth with social equity and environmental responsibility. Successful strategies will involve continuous learning, strategic partnerships, and a commitment to innovation, ensuring that global real estate remains a dynamic and valuable asset class for generations to come. The future promises both challenges and unprecedented opportunities for those prepared to adapt.